Welcome to the Gray Report. I'm your host, Spencer Gray, and every single week on the Gray Report, we're breaking down the latest research reports, news, articles related to the multifamily industry, commercial real estate, and the macro economy. So if you're an active investor or passive investor, you're in the right spot. Oh my gosh, we have a great episode today. It's our special AI and real estate episode. We have some special guests in the second half of today's podcast, going into details of how Gray Capital, we are incorporating the use of AI in a lot of what we do. Some of it are, specific kind of back-end root cases, making our systems more efficient. Others are doing things that we never thought that we could have been able to do before, providing our team unique insights as well as potential capital partners real unique insights as well. So you're going to stick around for the entire episode, but we're going to be getting into also what's going on in the multifamily industry first. So stick around. Griffin's here producing the show once again. Will's in the back room over there making us look good. Let's get into it. All right, welcome back to the report. Griffin, how you doing this week? What's going on?
Great. This week, exciting week. We're making a lot of progress, as you mentioned just in our intro there, in AI and the use here at Gray Capital headquarters across all operations. Exciting to see, as Spencer said, stick around. Our two special guests, you're going to get a sneak peek at some of the AI tools that we're building in-house and potentially publishing when we're ready. But it's an exciting time to be a part of the Gray Capital team. I'm doing pretty good. We have it's an exciting week. March has begun. Spring is upon us.
Yes.
Winter hopefully behind us. And so my affect is improving. How are you?
Doing well, hanging in there, getting through. It was snow on the ground yesterday. It's going to be 70 degrees by the end of the week. So dealing with that, but we're moving in the right direction.
Mm-hmm.
But just as the snow is thawing, maybe the multifamily market is doing that as well. And that's why I've been excited. But it's just, again, anecdotally, getting some really positive signs from our own portfolio of signing a lot of leases. And we might be entering the leasing season a little bit sooner as we have in previous years. And that's kind of how it was last year also. Things started more in March versus typically where they're kind of get going in April or May. And this is very well received because we've had a really soft 6 months or so in the multifamily market.
It's the great hibernation is ending, and the people are coming out of their homes in search of maybe potential new ones. As you said, maybe a needed early thaw, just because I think supply pressure specifically here in the Midwest, relative to the rest of the nation, maybe hasn't been as pronounced, but we've definitely seen it in our portfolio. So it's great to hear that we've got some leases signed. You want to expound on that at all? Give any details or?
Well, I mean, we've got 11 move-ins. I think this week at Solana alone. I mean, that's a lot of move-ins that are all kind of happening kind of in a short period of time.
Yeah.
Up in Michigan, up outside of Lansing, our property Club Meridian, we had 11 signed 12 applications last week.
Right.
Typically 4 to 6 is like a really solid week up there. So to do 12. Is incredible. There may only been a handful of weeks where we've had more applications in a given week. I mean, there's a lot of units up there. It's a little over 400 units, but still, and that's the difference between so much of the portfolio and really the nation, has been sitting kind of in like a low 90% occupancy range, even some kind of like that high 80s. And as an operator, that's not the end of the world, but that's really, it's uncomfortable. We'd really rather be kind of mid 90s, 95%. You start feeling good when you're 96%. And when you get to 97, 98, you start wondering maybe the rents are a little bit too low. I think the opposite question is that people have been asking themselves recently, or, maybe the rent's a little bit too high. Because again, if you're sitting at 88, 80% occupied, not that there isn't demand at those rent levels. It's just that, as you mentioned, there's more supply than there has been in a long time, even in the Midwest. Yeah. I mean, Indianapolis, if you look at most of the kind of market cycle charts, and it's relative Midwest versus Sun Belt. But I mean, Indianapolis is, kind of at peak supply. We're seeing a lot of vacancy. Again, it's not horrible. I mean, it's not like there's blood in the street, but it's hard to make progress. And we're still growing rents at a lot of our properties, but maybe not as much as we thought on some.
Yeah.
But it's more we're getting the rents. It's just we're not as highly, we're not as occupied as we'd like to be,
Right.
but we're starting to see that turnaround.
We will get to it. The median number of days a unit will sit on the market
Yeah.
before it's leased, but it's an astounding number to me, and I think I'll be interested to hear your thoughts on that number when we get there. But first, I want to jump into this week's jargon bin,
Yeah.
just to kick it off
Let's kick it.
for what is just another awesome episode of multifamily and commercial real estate jargon, stuff that we come across in our daily lives that we understand, but we'll throw it around kind of recklessly in conversation in the
Yeah.
office. We'll throw it around recklessly in conversation with investors. But let's break down at 3 levels of depth the term capital stack, and I wanted specifically start with the kind of elementary foundational understanding of what a capital stack is. And so I pulled up an image of a capital stack. It's a very, I think, boring, mundane, minimal effort image here, but I think it's a really good depiction of a capital stack. What does this image, mean on a fundamentally basic level? How does a capital stack function? And obviously, you see potential risk return over there with those different types of equity and debt. Just give me a really brief, basic explanation of a capital stack and how it impacts investors and/or debt originators.
Yeah. So, I mean, just simply, what is a capital stack? And the capital stack is how any sort of investment gets financed, any kind of deal gets financed. And here we're obviously talking about real estate, multifamily deals. And it's so, what is the kind of the stack of the forms of capital that go into the acquisition? Stripping it all down, if you were buying a property for all cash, your entire capital stack would be cash. It would just be truly, it would be kind of common equity because you're an equity investor. You're not using any debt. You're not using any sort of credit. It's all equity and it's all cash. So it would be 100%, common equity, or cash. But that's relatively rare, and especially larger private equity transactions. You typically have senior mortgages, and they can get relatively complicated. But really, what the capital stack in context of different positions is to describe a spectrum of risk and return, as well as the priority of payments. And also, just putting simply, the higher you are in the capital stack, which would be the last to get paid in this example. In this example, would be the common equity. Those individuals have the opportunity, not guaranteed, the opportunity to receive the highest rate of return, or at least that's how it's supposed to work. And the folks that are on the bottom of the capital stack, and I've seen this chart inverted as well, where the senior debt is at the top. But in this example, at the bottom of the capital stack, often the largest piece is the senior debt. It's the first to get paid. It should be the lowest risk because it's the first to get paid. If there's only so much money to be left over, there's not enough money to go around. Who gets the first piece and all of the first piece? It's the senior debt. But you're also going to get the lowest return in that position. Again, risk equals return, and it's reflected that way in the capital stack structure.
I want to try and reference the image that I'm showing, just the vertical capital stack in regards to essentially what Gray Capital does, just so our viewers can relate very specifically. This stack, it's not across our entire portfolio. This stack represents one investment, one asset, essentially one economic structure.
Yeah.
Okay. And then obviously you said it can be inverted. This one essentially goes from the bottom to the top. The quote unquote safest place to be in regards to overall level of return is the bottom, with the increasing risk going towards the top. That's due to the priority of payments going from the bottom to the top. And you mentioned it can get as complex or as simple as it can possibly be. There's several different layers of financing or equity that can be brought to a project in a typical Gray Capital project. And this is where I want to try to kind of dive into that intermediate understanding. We typically don't do any kind of mezzanine debt or preferred equity. And so our capital stack really does exist of that senior debt and that common equity, really only having that as kind of those two levels to our capital stack. Talk about the opportunity when you're an investor trying to understand, hey, I want to make this investment. There's a level of risk and return and that level of priority where what are some of the good questions or the good train of thought that an allocator, an LP investor would have when you're making a passive placement, trying to better understand the risk is also understanding that position in the capital stack.
Yeah, it's key. You need to understand who's in front of you. Where is there a contractual obligation to pay someone else before you can get paid? And if you're common equity, and again, there can be different classes of common equities. You said you can get really complicated, but the common equity is typically the first to absorb losses, and so you just need to be aware of that and saying, are there other folks in front of me that are going to get paid before I am getting paid? And just what that composition of the stack can impact your level of risk. Because again, if it's a 100% common equity deal, it's all cash. Well, maybe the common equity isn't going to get all of their cash back, but they're going to get some. If there's $1 million of common equity and you sell the property and you sell it basically for a loss, but not a total loss, partial loss, and you can return $500,000, well, that common equity is going to get the $500,000 back. So they're going to have a 50% loss versus if there were other layers to the capital stack, those individual layers that are higher up are going to get paid first. So the senior mortgage first has to get paid down. And let's say, again, if it's a 50% loss, and let's say that you were 50% loan to value, $500,000 was senior debt. Well, the senior debt gets paid 100%. They are made whole, and they've already been being paid interest. So they're completely made whole. The common equity earns zero. So again, that's a relatively basic structure. What investors need to understand is who else is involved, because there can be players in between the common equity and the senior debt, whether it's preferred equity, whether that's mezzanine finance, or different classes of common equity. Like some structures, you'll see different classes of common equity with different preferred returns. Maybe a sponsor is incentivizing larger investments, and they'll offer a higher level of preferred return for a larger investment amount.
How does just taking a look at the different levels of the capital stack, obviously you have your senior note at the preferred position. There's an interest rate. That's their rate of return on their investment. How does the different rates of return across the capital stack as you're moving more into the higher risk and or the back seats of the priority, how do those levels of return or rates of return at each level, how should an investor be thinking about those, trying to kind of classify and quantify their risk based on those rates of return at the levels that would precede them and the priority?
Yeah, I mean, you want to understand kind of what your goals and objectives are, maybe where you want to be in the capital stack.
Yeah.
Like the reason why you want to be in common equities is you want to have a lot of upside. If you don't need a lot of upside, you need a little bit of income, and you don't need to double your money. Well, then why are you in common equity? If you take a more senior position, whether that's senior debt, mezzanine debt, of where you're taking slightly less risk, but your upside may be it may be capped.
Sure, I think too, just the understanding of what percentage of the total equity. The total capital needs for each project.
Yeah.
So the loan typically in our projects is anywhere from that 60 to 80%. And 80s might be a little high.
Yeah, typically 60 to 75%.
75%. So then the common equity obviously then fills the remainder. In some projects where you do have a very complex capital stack, the different capital slugs or the percent of the actual capital may differ, and it may drastically impede or alter the overall returns or the chances of that common equity getting returns.
Yeah, it comes back to who's in front of you, and just again, really simple. It may be senior debt, mezzanine debt, preferred equity, but let's just put everything other than common equity into kind of the debt category. The more you lever that deal up, let's say you're levering it up to 95%. Well, if a little bit of loss in value at a sale, that common equity gets wiped out that much sooner.
Yeah.
But you have a higher opportunity to get a higher rate of return, a higher multiple, but again, risk equals return. So again, you lever it up to 90, 95%, and there's a big increase in value. Well, that, the 5% of the equity that you brought, maybe you could get a really strong multiple, but if things don't go the right way, that equity can be wiped out very quickly. Where that's why a lot of investors, don't always want to lever things up as much as possible, because they want a larger degree, they want a wider degree for error.
Yeah.
And saying that, the property can decrease in value a little bit and we're still going to get our money back. We don't have nearly as much money to pay back the senior lender. And then you just stack in, preferred equity. that their hurdle rates are going to be much higher than senior debt. So like common equity, if a common equity investor wants to receive call it an IRR of 15 to 20%, well, preferred equity might be somewhere between 10 and 14%. And so if you have a 14% preferred equity tranche right in front of you, and there's a lot of preferred equity, well, that's a lot of return that has to go to the senior lender. The capital has to be returned to the pref equity, and then they have to get their full pref back before the common equity investor gets a penny.
Right.
And so all that can work and be just fine. You just have to understand what it is, quantify it, and be comfortable with the risk.
Right. The muddying of the water in the capital stack. I'm just curious, what's the most complicated capital stack that I think you've been a part of?
That's a good question. I tend to avoid capital stacks that are too complicated. Now, the most complicated thing we've done at Great Capital is on our fund, we had two classes in our fund, A and B class. And the A class was essentially preferred equity. It was internal preferred equity. It had a 10% preferred return, and it's in a priority position to the B class members. It's 10% and zero. So after you get your 10% preferred return, once your capital has been returned, there's no more upside. You're capped at 10%. But it's great, 10%,
More of
annual
an income tool.
It's an income tool. If that's your goal, that's what you need to look. That's what you should focus on. If you don't need the upside, focus on the income. Conversely, our B class units, those were all about upside. And so they had an attractive split, but the cash flow is going to be lower because, again, the first set of cash flow is going to go to the A class investors. But once those A class investors are paid out, their capital account goes to zero. That equity has essentially been removed from the deal, and that's a lot more upside that will then flow to the B class investors. But there is more risk to the B class than there is the A class.
Yeah.
And in our case, people combine a little bit of A, a little B to kind of tailor a return profile.
Right. So if you're a B class investor in the fund, you make the investment. You may not see the cash flow for months, years. You have to kind of maybe be a little bit more patient. But the removal of the A class then kind of is that grand reward for that level of risk that you're taking.
Yeah, exactly. And so like what we're looking at is, as soon as we can, like our first disposition in the fund, that we'll be able to pay back our A class investors. They've been receiving their 10% preferred return, paying current, never miss a distribution since inception. They'll basically be taken out. Their money will be returned to them. Hopefully they'll be interested in investing in the next Great Capital deal. But then all of that cash flow that was going to the A class investors now flows down to the B class investors.
Understood. So it's not to say that the capital stack at the origin of an investment is going to be the capital stack for the duration of the investment.
True.
The capital stack can ebb and flow and change based on capital events, whether it's a refinance or a sale. There's other ways to replace maybe a recap of an asset.
I was going to say, I think recently there's been a lot of, with capital calls and recaps. I think this is more, time appropriate because what was happening is, people were getting capital called and they weren't understanding all of the details of the new restructuring. The capital call often, not always, often was a part of the that restructuring. But often there is preferred equity that was also layered in, and so people were asked to commit more common equity, but then there's going to be another preferred equity layer that's going to be put in front of them. So they basically have been kicked to the back of the line. Someone has cut them in line with a higher preferred return hurdle rate that they have to get paid before the existing common equity that may have been in the deal from the beginning gets anything. And so they're being told that, well, if you don't do this, the deal's going to fail and you're definitely going to lose all of your money. If you do contribute to the capital call, you might have a chance of getting some of your money back. Now they may say you might get a big return. I don't know what they're saying.
They can right the ship quickly.
But in a lot of the cases, the preferred equity doesn't even make sense. And it's like the common equity is going to get wiped out and the preferred equity is going to get wiped out. Like it's what needs to happen is this deal needs to sell at a loss and go back to the bank and reset the basis because you overpaid in 2022. Very fortunate. We're in the Midwest. We don't have to deal with any of that.
Right.
But I know a lot of LPs that are listening have dealt with it. Sponsors are dealing with it. It's a real thing. And it's a challenge. And so it's just in LPs who weren't, they maybe understood multifamily a little bit. They understood real estate. But now they're in a situation of like they may or may not know the full structure of what they're investing in, and to determine whether they're putting good money after bad is a complicated question. And if you don't understand like the order of operations and how the cash flow works and how that capital stack plays into it, you're making just an uninformed decision
Right.
for
It was a
risk.
great example of the capital call. Really, in the last few years, we've seen several of our LPs here at Great Capital, mention that in our equity raise that they're impending capital calls, and just that conversation of trying to get them to be able to visualize and understand where that money will sit in the capital stack and how at risk that capital truly is, and is the overall projected return for that new capital allocation truly worth the level of risk that they're taking.
Yeah.
And so I think to summarize the capital stack conversation here at the Jargon Bin is it's really just a spectrum of risk and return and priority in regards to how the cash flow distributions and any upside or proceeds get divvied out amongst anybody that's got an interest in that project.
Yeah. Yeah. Well said.
Awesome. Interesting. Let's move on because we've got two articles pulled up. I think they're largely similar, but I just teased prior to our intro the grand number of days that a unit sits vacant in the U.S. multifamily market. I know you know the number. I'm just curious as to what you think of the number without divulging it.
It's high. It's not shocking, kind of given where we are in the cycle, though. I mean, we just have a lot more apartment units than we did a couple of years ago, and we have less people looking for apartments. I mean, there's been a lot of immigration has been going the opposite direction. I mean, immigration has helped out the rental market, and we've seen whether it's the state of union or whatever, we've had a lot of folks that have been leaving this country, and it's been challenging. And we've also delivered more supply. There's also uncertainty. So apartment units are sitting vacant longer than they have. This goes back to 2019 since Apartment List started producing these types of reports. You could go. I'd be curious going back and look at like 2004, 2006, or 2000 and 2008, 2009. But again, I mean that's a trend upward. I think the question that most would have is again we're at the peak of seasonality right now, the low point of seasonality,
right?
Or we better be, right? There's some green shoots.
Right.
We are. It's just the trend is higher lows and higher highs, and that's a trend upward, and that's not what we want to see when we're tracking days vacant. So we're entering the leasing season. What we'd like to see are some lower lows. We'd like to see that days vacant kind of be at like 25 or so, maybe, to show that we're moving in the right direction. Because 41 days peaking, I mean that's high. I mean it was in 2022, it was 25 at the peak, not at the trough. At the trough, it was sub 20. Prior to the pandemic, it was kind of anywhere between kind of 25 and 35. So we're past that 40-day mark. So we need to hopefully come back down. So new deliveries are slowing down. We're still going to have a lot of new deliveries, but that rate of growth is slowing down. It should support a normalization over time, but we'll see if it's a season or two.
Right. Each week I get tasked with the opportunity to try and put together a social media post in regards to the newsletter and the podcast.
Bless you.
And this specifically stuck out to me. And for those of you that are not watching but listening, Apartment List produced a report really focused on January and February rent as we start 2026. The median list to lease time, how long it takes from when a unit is listed to when the lease is signed, hit a new high relative to the last 7 years. And that is a total of 41 days that unit sits on the market looking for somebody to come and sign a lease. That's a long time. It's 2 weeks, longer than the trough back in 2022, which was 26 days. And so when I saw this graph and I was reading about it and trying to understand, how to articulate this on social media and why I draw attention to it. But in our monthly and quarterly reporting and our investor calls, I think it's been notable that we've had occupancy challenges across our portfolio. We've seen vacancy tick up, not to levels that are I don't think that are scary to Gray Capital and Gray Residential in our operations. But if you're an investor, and whether you're an investor in Gray Capital, you're an investor in another multifamily syndicator, or you're just interested in the space, I think this is a really good indication and visual as to what is currently happening in the market. It's not just happening, out in California. It's not happening down in Texas. It's happening across the nation, and that's just an average. Is 41 days, and so there are markets where this is likely drastically higher, maybe outliers, but there are also markets where this can be quicker. But I just wanted to pull that one stat out because I do think it's a really good indication, data
Yep.
visualization for what we are currently experiencing within our own portfolio. Let's run through this apartment list report real quick and just take a look at some of the data visualization tools. We love to look at this specific graph. It's the overall month-over-month rent growth based in starting in 2019 and running all the way through January of 26th. You can just see that common theme, the common trends of the slow leasing season as you enter the back half of the year and winter here in the Midwest, and then exiting seemingly earlier and earlier each year into the early months of spring. This is, to me, somewhat exciting because we're starting to see some positive trend nationally in month-over-month rent growth, but you can certainly see that these blue bars are obviously negative trends, purple bars positive trends. We're inching closer and hopefully going to see in the next edition or rendition of this report a purple bar trending up.
I mean, we just need to look at the last couple of years and when things have peaked, and it's been surprisingly early. Again, especially comparing to like 2021 or previous cycles,
You're
where
right.
kind of June, July was the peak of leasing season. But now that's been shifted much earlier to where the last 3 years, it's really started in February and peaked in March, which is really early, and then kind of flattened. I mean, last year we peaked in March and then we started declining. I mean, look, January, February, March, and then April, May, June, July.
Right.
I mean, we were in basically negative by July in August. Going back to 2021 and previous years, again, it was June and July. February and March were fine. They were starting to accelerate and pick back up after the winter, but they weren't what the show is all about. Again, look at 2025.
Right.
I mean, March peaked, and then that's a steady decline, and I think that's competition and supply. In previous years, I mean, that's where last year was. It was tough. It was rough because it's like this is July and we're seeing negative, rent growth. That's how we knew that things were really,
Right.
slowing down and supply was really taking taking effect. In 23 and 24, which I could maybe what we could see this year, although I could potentially see a pickup. But it was more or less flat. Kind of got going in February and hit March's level, and it just kind of flatlined until we kind of got through the summer, and then it turned negative.
Right.
The question here is, do we turn? Do we stop in March, or do we peak then? How long do we plateau? Do we continue to grow? And then is there any lift near the back half of the year, as some suggest there might be, given that a lot of these units should be absorbed by then? Or do we have to wait till 2027 before we really
Right.
start to see some new gains?
The trends that we're seeing in the month over month can kind of similarly be seen in the year over year, but it's a lot more flat relative to the long frame perspective.
But it was a
obviously-
leg. But it's been flat. But it's definitely a leg down, and I would say deteriorated the back half of 2026.
Yes, 2025. Yes.
Yeah, sorry, back half
absolutely, just like you were
2025.
talking about. And you mentioned previously in the episode, we're seeing a lot more volume in leasing potentially.
Yeah.
Signing more leases, giving more tours, and I think it's a good indicator of the progress that's going to be made earlier in the year. It's March now, so it's the expectation is that there will be a slight pickup.
Yeah.
In overall.
So operators,
Right.
owners, now's the time. It's not like, all right, let's wait till May. Like now, it's you get all of your leases. I mean, the anecdotes. That's why I brought up the Club Meridian. At Solana, we're seeing the traffic. We're seeing, this is just anecdotal information from our portfolio, but we're
Right.
seeing that traffic pick up. Again, is it just a March story? Are we going to plateau afterward, or is it going to sustain momentum? I don't see anything other than take the whole thing with Iran out.
Yeah.
The sentiment hasn't been great. The economy isn't great, but it hasn't been falling apart either. There's really no like concrete signs like, okay, we're in a recession, we're going into a recession, other than like fears around AI and unemployment. But the unemployment rate has been relatively healthy. So everything was kind of being fine enough. I think maybe people were just kind of over it and numb. What I don't know is our latest expedition to the Middle East or adventure in the Middle East, if that's gonna
Right.
how much that's going to dampen the market. And again, we could have a whole episode on the potential economic impact,
Totally.
which maybe we're not making any promises. Maybe that's next week, probably not. But I mean, we're looking at some supply squeezes with potential inflationary pressures similar to what we saw back in the pandemic. Again, I hope not, but I mean, the Strait of Hormuz is closed right now.
Yeah. Yeah,
So that is definitely going to have some adverse impact on the global economy, the U.S. economy, and we haven't done all the macro analysis. I mean, it's pointing a lot of different directions right now. We'll hop in the operator later.
Right. See how it impacts
exactly later in the
multifamily
episode.
rents.
Exactly.
So I want to switch over to the CoStar, and I believe it's apartments.com report. Specifically, I want to just take a look at this first chart and really just take a look at the end of 25 and the first 2 months in 26. So December 25 to January and February of 26. And just putting the newsletter together and trying to piece together all the data, provide a kind of a synthesis of the sentiment in regards to multifamily rent growth. We've had what I would think is a very optimistic start to the year in January and February, both seeing upticks. But from January to February, it might be minuscule, it might be insignificant, non-meaningful, but there was a drawdown in overall, or a slowdown in overall rent growth from January to February. And so just like we're talking about the optimism for March, I don't want to get too caught up in the fact that we took a drawdown from January to February, and we're back where we were in December. But I think just seeing a full quarter of consecutive positive rent growth is encouraging.
And I mean, the rate of change slowed down. It halved, and the overall year to year, obviously, kept going down because there wasn't another big lift to compensate. I think it's too early. I wouldn't say that we have like the evidence. That's why I say it's a lot of anecdotes and stories here or there.
Yeah.
But yeah, the data is not necessarily playing out. And again, this is like. But these anecdotes, I would say that wouldn't be captured in that. The anecdotes are like within the last week or so. Literally like within like days. That wouldn't have been captured in that report.
There's all sorts of great data visualizations in these reports, and I hate to get too caught up in them, but these are always interest me, just where they list the markets, and this, I believe, is year over year. So it's just interesting to see. Obviously, there's still a significant number of markets that are having negative year-over-year rent growth. I always love to pull out the Midwest markets because we always like to talk about the compounding of incremental. So maybe it's slow growth, like we talked about in our Midwest multifamily forecast, but we are still seeing some positive rent growth across the Midwest, and it's just exciting to continue to see that in the data and in some of these data visualizations.
Yeah, I mean, San Francisco, it's kind of better late than never. I mean, San Francisco had many, many years of negative rent growth all throughout the pandemic, including the years of 2021 and 2022 when we saw the largest gains. And so, like, while markets like Austin saw massive gains during that period of time, they've now seen negative rent growth for a couple of years. San Francisco saw just negative growth throughout the entire time period, but in the last little less than a year, it has finally kickstarted. I mean, and then that's a combination of return to work, the COVID turning off because everyone left San Francisco at the time. It was too expensive. The rents came down, so it became more attractive. The AI boom is obviously making major waves in the San Francisco, Silicon Valley. I mean, they've got a new mayor there also, and so who has been more or less kind of cleaning things up and making it a much more kind of hospitable place to live. Or at least that is according to the folks that I know who live there. But yeah, at 5.7%, everyone you're now growing off of years of negative growth. And so I think it's good looking at that aggregate long term.
Kind of digging themselves out of the hole here in 2025, 2026.
Yeah, and Austin's like still coming back to earth.
Yeah, right. We teased our viewers and our listeners earlier on in the episode about our conversation we had with two special guests. Before we jump into that conversation, because it's all focused on the use of AI tools, specifically here at Great Capital, but kind of across commercial real estate.
I don't think we should do it.
You don't want to use AI?
Well, no, I don't think we should give all our
All our tidbits away.
yeah.
I think that's fair. In-house,
We probably should.
competitive advantage.
It's fun. I think it's there's a line in the sand where I struggle with of not wanting any of our competition to know we're doing any of this.
Yeah.
But then there's also there's plenty of markets, there's plenty of investors, relatively friendly, competition. And if you everyone start using these tools. I mean, it's going to make the market more efficient. It's going to make the market better. But also not everyone's going to be able to do or want to do some of the things that we've done or are doing. There's just not going to be the will. And the conclusion that I've had, and it's not just about AI. I mean, this is about anything in life, which is a lot of these lessons are. It's your capacity to do something is only a limit to your imagination and your willpower to do it. And in the past, the knowledge and like the skill sets were also a barrier. You could still learn anything. You could still learn to do anything. But AI has allowed us to leverage our time and created so much leverage to do things that we did not have the skills to do earlier. Whether we can gain the skills faster or it has the skills embedded in terms of like coding, building, and really on the whole coding side.
Yeah.
I've never like coded. I mean, again, I've like played around on our website. I had to fix the little thing HTML here or there.
Yeah.
Back in high school, okay, we're going to make an HTML document.
Yeah.
But I was comfortable in my life saying I probably will never like learn a programming language. I'll never code. I'm comfortable saying I'm not going to learn Russian. Like I'm okay going to my deathbed, just not learning Russian. Would I like to? Sure, but I'm not going to probably find the time to learn Russian,
right,
or Korean or whatever. And I was the same thing with JavaScript or Python. I was like, it would be nice to know, but I just don't see myself making the time to do it or a need to do it.
Right.
But now I've been working, late at night, basically taking my evenings to. I think teaching myself to code is like not the right way to do it because I am learning how to code and I am coding. I think the term is vibe coding. But I have, multiple, I'm using Claude Code, I'm using Cursor, and, I'm basically working on these coding projects and building things for Gray Capital and Gray Residential that I've always wanted to build, but I've had no idea how to do it. And the barrier to entry seemed to be so high that it just wasn't worth the time to even make an attempt. Now that barrier has come down so low that now it's a limit of what can I imagine? A little bit, how much time do I have to dedicate to it? And, the willpower to persist to get it done.
And the direction this conversation is going, I'm excited to get to the conversation with Blake Peroni, senior manager of capital markets at Gray Capital, and John, he's our data scientist, and talk about their use cases in AI and how they're rolling it out, building tools for their daily use. But before we do that, I want to just ask you to kind of summarize the vision for Gray Capital and AI. And so we're filming this early on in March. We have a first Monday of every month. We have a meeting. Typically, it's kind of not a State of the Union, but it's a big all hands on deck meeting where the leadership here at Gray Capital, yourself included, kind of sets the path for the month, objectives. We know what everybody needs to be focused on. This Monday and for a couple of days leading up to it, the focus has really been on trying to find creative and advantageous ways to implement AI into our daily work routines in order to reduce friction and increase productivity. And we've kind of sent everybody off on small private missions. And some of those have been assigned. Others have been free to choose their own path and create solutions to their own problems here at work. You've been generous enough to purchase and roll out enterprise versions of a lot of this AI software to everybody in the office, giving everybody those tools at their fingertips. A few members of our team have jumped on this with enthusiasm, and I've been working hard at work, but also similar to yourself, going home and trying to figure out how they can best use their time to get to work and have something to utilize to increase efficiencies. We're operating kind of siloed right now. We're each building our own projects. You've got a few that are really impressive and very exciting. Blake's got a couple. John's got a couple. I'm working on my own. I'm sure Jay and acquisitions. Everybody's got their own thing, but I want you to kind of just talk about your vision for Gray Capital and where you see all of these AI tools and how we can merge them all together to kind of form what I think you somewhat, not jokingly, but you mentioned on your social media platforms the other day that Gray Capital is now an AI software company.
Yeah.
And I think that there's a little bit more truth and a little bit more serious to that than there was maybe in that social media post. So yeah, go ahead and just give us kind of a quick summary on your vision for AI at Gray Capital.
We can build the company that we've always wanted to build. Like, we have the tools to really create it in our vision, in my vision, but again, a collective vision, and to work the way we want it to. So often we are forced to choose the tools that are like on the shelf, like products, technology products. And we're locked into contracts. We're locked into others' workflows, and our experience, whether it's on the employee side or the resident side, is very much locked into, again, third parties, third party experience. Everything from our property management systems and how individuals interact to just employees, how we look at deals, how we interact with each other, how we do everything, and so there's a multi-pronged approach. And first off, the objective is we're working on right now while we're doing some experimenting is to get organized, because we have we announced this is all internal stuff, but we're having a small like an AI summit next week on Friday, which is to kind of combine and to really set a really specific direction to prioritize the projects, because we look around and we see opportunities to improve processes using these tools in every area of the business. But like, we have to start somewhere. We also don't want to get too distracted in leading ourselves down like one road. You'll see here in the next segment, we're working on all these interesting projects, and some of the projects like that I've been doing have been to teach myself how to do all of this. And it's like, all right, is this a tool that we're actually going to use? What problems does it solve? Like, some of the answers are like, well, this doesn't really solve any problems. This is just a different way of doing it. And so is that really the priority? So there's a couple different categories, that we're kind of putting some of the initiatives in. Some of those are just, taking our, current processes and workflows and automating those processes and workflows. So we're really not just changing much. We're just making them faster and automatic. Some cases we're creating whole, new workflows for things that we weren't able to really to do before. And so it's taking, now it takes a fraction of the time. Now we're like adding on to that workflow, to optimize it. The other part is actually building our own tools. And we're going to just show a couple previews of some like very like early kind of prototypes that we've been working on. Now, it's one thing to get something to like a prototype stage. It's different to have something kind of fully deployed. And we have a couple of different tools that are in different stages of deployment. This is going to be a years long process, but we are actively hiring at Gray Capital. Most likely we'll be bringing on a probably full-time software engineer here in the near future, because when we look at from a purely like numbers standpoint, when we look at what we spend on software, we spend a lot of money on software, hundreds of thousands of dollars across our properties, across corporate entities on software. Some software is great. We can't get rid of it, can't remake it. We don't want to reinvent the wheel. But there's a lot of software that we've had, we're paying money for, that we've never loved it. It's just been like the only thing that was out there, or the good enough thing that we have to have.
Yeah.
And some of it's like, yeah, it's good, but does it really do the job that well? And we've gotten comfortable to a point where there are some very clear like pieces of our tech stack that we've identified that we can either completely recreate in our own image, that we're not reverse engineering, we're just accomplishing the thing in a slightly different way, and oftentimes it's better. And so whether that's how investors interact with us, eventually how residents interact with Gray Residential, the properties themselves, and the prospective resident intake. So instead of spending, I mean, $10,000 or $20,000 per property on another piece of technology, or these companies will charge dollars per unit. We can bring that to the bottom line essentially,
Yeah.
and run on these properties much more efficiently, not being reliant on third-party software vendors, but also being able to create our own bespoke experience again for our employees, the way we want them to use it, for our residents, how they interact with us, and then also our investors. And those are the three stakeholders right there. And just changing the whole experience of how folks interact with Gray Capital and Gray Residential.
Yeah. And it's exciting. Just, I think from the outside looking in, if you're an investor, or maybe you're another operator, maybe you're a vendor, maybe you're just a adjacent service provider to the multifamily industry, maybe you're in software and you're looking to get Gray Capital's business. From the outside looking in, I don't think there's anybody that knows how much software we actually employ here.
It's a lot.
Because it's so many different platforms and providers. And so, and they all have their purpose. There's an opportunity to, like you're saying, not reverse engineer, but build something that is maybe novel or additive to that software that now we can communicate between our own projects that we're building through AI, bring them all into one central hub and have this really communicative ecosystem of software that works together across all of our platforms, and we all have access to it. And it's so seamless.
Yeah, exactly.
And so I hope everybody enjoys the conversation, because John has some really incredible insights. He's bringing some very incredible data, some data visualization. It's an acquisition tool internally here at Gray Capital currently. And then Blake, just when he's talking about how he's using AI to essentially trim down his time behind the computer screen doing administrative work in order to get him out front of investors and continue to kind of navigate the capital markets, to free him up to actually, go be, purpose-driven capital raiser for Gray Capital, as opposed to somebody that's behind the computer generating investor reports and sending investor emails, which is important. But currently in today's state, we're just utilizing a little bit too much of his time doing that.
Well, it's more, we talk about it in the interview, but it's more time for all of us to spend with investors.
Right.
And the human, the connections that I guess only people can do, not behind it's less time behind a computer screen and more human interaction than there was before.
Yeah.
So I think let's get into the interview.
Let's get into the interview.
Cool.
Enjoy it.
All right, we're back at it on the Gray Report. A couple special guests today, Blake Peroni and John Chapman, both on the Gray Capital team. Blake, John, how you guys doing today?
Pretty good.
Doing all right.
Good stuff. Just quick, I want to do some intros. And regular viewers of the Gray Report they know Blake and John both have been on the Gray Report multiple times. Blake, you want to just give a quick intro for what you do here at Gray Capital?
Yeah. So I primarily focus on capital markets, investor relations for Gray Capital. So debt and equity for the projects that we're acquiring, as well as doing a lot of the reporting monthly and quarterly for the assets that we have, sending distributions and really servicing any kind of questions or supporting anything that any of our investors need or want.
Yeah. John, how about you give a quick introduction to yourself, what you do at Gray Capital?
Yeah. I do primarily data analysis and number crunching among a wide variety of topics, particularly targeting several macroeconomic indicators to give a pulse on where the market may be heading in the future, to give the company better insights as to how to place their investments.
Awesome. Thanks, guys. So I want to first start with Blake, with you. We were working on our monthly investor reports. We do monthly reports here at Gray Capital, as well as larger quarterly reports. And ever since I've started the company, those reports are critically important. Communication is key, but they take a significant amount of time. Shifting from quarterly reports to monthly reports, and first it was just quick monthly updates, was a large task. And often it's taking, your time and Griffin's time at the end of the month. We're taking a couple days putting these reports together. And then when the quarterly reports come around, that's, a week and a half, of work. So it was, a clear opportunity to say, how can we be more efficient, but also understanding that the quality of our reports has allowed us to retain investors. One of the things that we hear all the time from our partners and LPs is they love our reporting. It's transparent, it's consistent. So how do we make it better? But Blake, you saw an opportunity to improve the efficiency of these reports using AI. Can you kind of bring us through the process, what you identified as the problem, and then what was the solution? Just kind of walk us through what you were doing last week.
Yeah. So as you mentioned, I mean, 2025 and prior, it would probably take Griffin and I 1 or 2 days for the monthly reports and probably a week for both of us for the quarterly reports. We had 20 different Excel sheets for villas monthly, villas quarterly. We would have that for every property and in a very specific structure that helped us put this data into our PowerPoints very efficiently. So it had to be kind of in this thing. We had graphs that we really just had to drag a bar down and it would update for January's financials or February's financials. And so instead of doing those 20 Excel files, we had Claude help us bring all of that stuff into one with the Excel Claude like built into Excel. That took a little bit of time, but so now we have one Excel file for all of our monthly and quarterly data for all of our properties. And then we downloaded the trailing 12 financials and the previous month's report for each property and said, please update these PowerPoints. And we also gave it that data headquarters, and it basically put in all the data for us. And so, one Excel sheet, one PowerPoint, one trailing 12 statement, and then it in 5 minutes spit out the January PowerPoint, which would take us, I don't know, 1 or 2 hours per property.
And so breaking that down, there are 2 parts there. One is building that kind of like master spreadsheet to bring everything into one. Why? What prevented you and what prevented us from doing that before? Was there just not the need, or just like it was going to take a lot of time to put all that together?
It was going to take a ton of time to put it all together, but there really wouldn't have been any like extra efficiencies from just having one because everything is so segmented. So we could have done all that work. It would have taken 1 or 2 weeks, but then on the other end, we wouldn't have really gotten much gain. Now we just have that one sheet, and every time there's a new month ending financials or quarterly, we'll just give it the same sheet. And the next step for us is to either connect it to RealPage or some way automatically get the financials from RealPage to Claude and have it update this sheet without us really doing anything on the 15th or the 20th of every month.
Yeah. Well, and then that is one of the big challenges we're dealing with right now is just exploring the world of, open AIs and closed APIs, and which vendors and third parties are more open with their data and their APIs and which are pretty closed off. And we're working with RealPage right now. They do have API access, but I wouldn't say it's completely open. So we're working through that. Right now it's a process, correct me if I'm wrong, of basically taking data dumps, CSV files, Excel files, and then manually dropping that in, which again is doable. Part of that probably can be automated, again, through some, like a report scheduler and coming in, grabbing out of your email box, but it's a little bit clunkier than it probably should be. Right?
Yeah. Right now it's like, oh, you could try these 3 workarounds, or you could just connect me directly to the website and I could pull it all for you. And it's like, you just need that software's API. And I'm like, oh, well, I don't have that right now. Or it's choose one of the workarounds.
Let me ask you this, because I think the question that a lot of people have been asking, or the statement people have been saying is, well, I use ChatGPT right now. Isn't it the same thing as Claude? Yeah, I'm using an AI, I'm using ChatGPT. And that's kind of what I said a couple of weeks ago. I'm like, yeah, I know there's other models out there, but they're all some are better than others. One leapfrogs the other, but they're all close enough that it doesn't really matter. Why are you using Claude? What's the difference? What's the use case, and what's been the inflection point to use it versus using ChatGPT, which we had a couple of weeks ago?
I think if you remember the step change of before there was any ChatGPT or AI, the first time you used it, you were like, whoa, I don't need to go to Google and search for these blue links to find my answers, and it just kind of gave you it. If you remember that step change, I feel like going from ChatGPT to Claude Cowork has been an additional step change where, hey, I want to develop this workout program for myself, or I want you to make these 5 PowerPoints for me, and you type in 3 sentences and it creates it. And that's been a pretty big change for us in the past 2 weeks. I mean, it's just kind of smarter all around. It kind of has better intuition of kind of what you want, asks questions in a really thoughtful way of things that it doesn't know. And I feel like it learns a lot faster, like the memory that it has with it. And like the first PowerPoint that we had it do, it probably took 10 minutes for the monthly report. And then we had the markdown file. And then the last one, it took less than a minute.
Yeah, that's awesome. Where do you see this going? What are some other use cases, ways to, I guess, further improve the process? Obviously, talking through the API and getting the actual like data injected, so it's less clunky. But now, I guess some of these tools, any other kind of use cases or things you're thinking about, other ways to incorporate, make things more efficient?
Yeah, some of the problem I feel like is the limit now seems like my imagination and of how to use it and like what questions do I even ask or like things do I even ask it to help me with now, which is kind of interesting. I don't really know where I see it going 10 years from now. There's that saying that like you always kind of underestimate or overestimate what you can do in like 1 year and like underestimate what you can do in like 10. So like in 1 year, I don't know how much would be different with Claude or kind of our systems, probably a significant amount, but I can't even imagine what's going to be like 5 or 10 years from now. I can't even, yeah.
Yeah. Let's bring John and Griffin into the conversation. Griffin, what was it like? I guess the difference between last month's process, this month's process.
Right. I think we talked about in the office amongst Blake, you and myself, about the over the course of a year, 2 years, but a month, how much time is actually being saved. That now frees Blake and myself and anybody else in the office that's utilizing these tools to create efficiencies, reduce friction. All of a sudden now we have this time to focus our attention, our energy, and our effort elsewhere. And so it's been really encouraging to watch the progress being made, whether it's what you're building, Spencer, which I hope we get to talk about, what Blake is building, what John is building. It'll be really interesting to watch everybody in the office all of a sudden have free time to divert their energy and attention into building something else, being more efficient in another category. And so while I'm watching Blake and myself utilize AI across our monthly and hopefully hear quarterly reports in what'll be 2 months, it is quite astounding of how fast it will produce something, the quality of the work, and then on the back end of having that production of a PDF or a PowerPoint file, all of the accuracies that it is able to display in regards to formatting, installing our brand components across the reports, things that otherwise were meticulous and tedious and oftentimes probably overlooked by our investors or the consumer of this product, that are spot on and it's done in a matter of seconds. It's just really, really encouraging that you asked Blake about 10 years. I don't even know where we're going to be in 6 months, just because it's growing so fast and the progress is so speedy. And so it's exciting to think about, well, if we've gotten this far within what is, a couple months to years of use, where will we be in that 6 months to another year?
Yeah, it really is like just a really different form of leveraging our time. And,
Right.
and who knows with that kind of leverage, kind of how far you can get. And we really don't know. Talking about the decks, because that's another time. It's so important. Again, one of the reasons why I think that we're successful sometimes, what I hear from investors is like, your guys' decks are so good. They're so detailed. You answer all my questions. They're well thought through. And that's our intention. We do put so much time into them. You had brought up a solution that wasn't a cheap solution,
Right.
maybe 6 months ago or so. And you're like, hey, there's a company that will basically like build out our decks. They use AI and they'll build out our decks.
Yep.
And at the time I was like, I don't know. I don't want to lose us. I don't want to just ship it off and have something that just doesn't do the same, doesn't have the impact. But the reality is we can now, with just using the tools, whether using Claude or similar, we can really compress that time down.
Right.
Talk to me about, I guess, how long it would typically take for us to put a complete investment deck together.
Right.
And yesterday we were working on templatizing essentially
Yeah.
our markdown files and our plan to our next project, which get ready for it. We can basically flip a switch, drop in a couple key assets, and produce something, probably with some editing to do at the end of afterwards, but like in a fraction of the time. Tell us where we're at.
I mean, without just jumping into the details, we're probably saving ourselves a month's worth of time, if not maybe 3 weeks.
A year?
Or
Or just a period. Yeah.
1 month
per project.
project. So if we have four deals across the course of a year, that's 4 months of time being saved.
Yeah.
And the way that we've built our decks in the past is we've kind of had this template where the intro slides operate in a specific format when the underwriting slides have a specific template format. We've been using those, and we understand internally that the deck build out process is fluid. As details change, you make edits, but really the construction of getting version 1 of that producible, consumable deck to our prospective investors and existing partners, that takes anywhere from 3 to 4 weeks to plug in all the assets, get it formatted, get the copy, proofread it, provide data visualizations. The whole thing really does take about 3 weeks. And so to incorporate AI, specifically Claude, and what we're doing, it's an immense amount of time saved that Blake and I can kind of be unleashed, have investor calls, and be out there actually raising capital as opposed to being behind the computer trying to put together our sales materials.
Yeah. Which, I mean, so go ahead, Blake.
And we've talked about how much time the deck or the reports monthly or quarterly takes, and I think we're pretty proud of those and like the quality of them. But I think we are also at a point where we thought that the quality was sufficient for the amount of time that we spent on it. I think now that we have some of these tools, we can turn up the quality even more to match, the relatively short amount of time that we should need to spend on it. And we've talked about, building out some things that potential LPs might want to see in an investment deck that they're looking at for a potential investment, whether it's a calculator or different sensitivities or like probabilities or, more interactive things that we haven't been able to put into, investment decks in the past that we hope to on the next project.
Yeah, I think for me that's what's really exciting is the more things that we can do, and I have to be careful because you can just go down a rabbit hole of we can do all of these things, and we have to be selective of like what we actually have to focus our time on. But we're having these conversations of how should prospective investors interact with us in the deal, and we'll always be doing calls and meetings and lunches, and that's a core component that we never want it to go away. But we've also identified that there are instances of where right now it's you get a deck, you get like a PDF. We've made an addition to that of we also do a video. Basically, we go do a breakdown of everything about the deal, and then there's a webinar, and all that's still great, and we're going to keep doing all of that. But now there's all these other ways that you can interact with us in the deal, and one concept that we're going to have on our next investment opportunity is like an interactive interface and like a chat bot where you can ask it. It has the whole deal. It has the whole PDF right there, but you can go into detail and ask it any question about the deal. You can ask a question about Great Capital. You can ask it questions, and I think this is where I think investors are going to like it. Investors will be able to ask it questions that they might feel uncomfortable asking you or Blake or myself, because everyone wants to be nice and we're on a call and no one wants to rock the boat too much. But that prevents, and sometimes people do. Some people try to, go pretty hard at us. We've had some, hard investor conversations. But you can kind of ask all the awkward questions. Like if you guys ever lost a deal, what's your worst deal? Going into the detailed track record questions that maybe people they know it's so important, but they kind of skip through it because they don't want it to be like awkward at all. You can have all of those conversations offline, and then you can go and say, hey, I need to have a meeting with you guys. You guys need to tell me about this deal. I asked your interface and it said X, Y, and Z. I want to go into more detail about that. If the interface can't just go into detail in itself. But then just the actual calculators, we've talked about that for years of being able to dial in under certain circumstances. This is what the return looks like in a way that's more interactive than just an Excel model.
Right.
And all of that is very much doable. And we have the time to do it because in the past, to your all's point, it was just trying to get the deck completed, the PowerPoint presentation.
Right.
I think it'll make people more comfortable too. $100,000 is a lot of money. Whether it's the meetings that didn't happen because maybe they felt like there was too many questions that they maybe didn't know or weren't so familiar with. I think there's maybe some new LPs that could come into the space that never really considered it because they're, learning more than they would have had they not, played with the tools that we're going to implement.
Yeah, right. It's definitely can be an education tool as well. We get folks that otherwise want to kind of dive into the model per se and adjust, any of our inputs or assumptions. If we send them our model, it's quite complicated. And so if you're a a new investor, or simply you've just never seen our model before, it is really kind of intimidating. So you jump in, maybe you break it, you delete an input that otherwise is needed, you don't know where it came from or where it went. This interactive, deal room that we are working on constructing is going to allow our investors to get in and manipulate variables, in real easy, simplistic, reduced friction type of ways, to where they're also going to be able to understand how certain inputs really can impact the overall outcome of a project or an investment. So just give them really unfiltered access to manipulate the deals, learn how it's impacting the overall returns and or the results of the project. It also should be a lot of fun to use.
Yeah. I mean, we're not even getting into on the acquisition side, how we're using it, to how we've changed our model, the different types of sensitivity analysis that we're using. So there's a lot of kind of just behind the scenes stuff also that just made us that much kind of quicker.
Like what John's working on.
Yeah. Well, then that's what I want to pivot to now. Great Capital, we regularly release research reports. We've always been passionate about data and research, and started aggregating data with the Great Report newsletter, back in 2020. John has been on the team almost a year now, working on research reports with us. Started its undergrad student, as an intern, and has risen through the ranks, and has been able to produce some really incredible reports. The Midwest multifamily forecast for 2026 was really kind of a benchmark report that made a lot of waves in the industry, some really keen insights. It's also worked on developing some kind of novel approaches for forecasting the ratio between starts and deliveries. So John was the next project that we started working on, was to give us some insight into properties and areas. John, can you tell us a little bit about first how we started with like this latest research project, kind of where it started, what you had to build, and then kind of get into where it is today and some of the tools that you've been using to put together a really, I think, incredible deliverable.
So starting off, really, it was a set of questions that we wanted to ask. The chief primary one being, is there a way to make the data more granular, even down to, the zip code level or even the property level? CoStar is great in many ways, but if you're looking at, a market or a submarket, that's about as granular as you can get. So we started by asking ourselves, is there a way to make this data even more granular, even more, location specific? And that's kind of what spawned this dive into zip code specific metrics. From that kind of conversation, from that kind of outline, we've been developing a scoring system really that can score zip codes by macroeconomic indicators. We're talking about things like poverty rates, unemployment rates, even stuff like distance traveled to work, or the percentage of the population that is considered a dependent. Looking at all these macroeconomic indicators to say, what kind of conclusions can we draw about this zip code, or even to get even more microscopic, about a property inside this zip code. This involved a lot of data aggregation, and to speak to the point of how AI has been able to transform many of the ways that we've been able to do business. I was spending hours upon hours a week just trying to aggregate the data, scrape the data from different sources, the Census Bureau, CoStar, different locations, to make this research possible. And what I found was we were starting to even hit kind of a wall where, in order to make this, an achievable project, we needed to be able to scale it up to a large degree, going from, a few zip codes and hundreds of properties to thousands of properties, and, hundreds of zip codes. And really integrating AI, specifically Claude and Clawbot, has allowed us to autonomize a lot of that data collection process, to now pull thousands of properties, metrics automatically. And what was taking, a matter of hours, now takes, a matter of minutes. Clawbot specifically has been great for this data aggregation because even Claude has some issues sometimes with, timing out after it runs for a while. But Clawbot, you can just set it to go and leave it running for an hour, and you come back and you've got 1,000 more properties downloaded. So it's been truly transformational in this project. It has elevated it from something kind of novel and kind of cool to look at, maybe for like the Indianapolis area, to us being able to generate a ranking and scoring system, and then I'll show it in a minute, but the heat map for many cities across the Midwest. So I can go ahead and show off the heat map if we would like, or if you have a follow-up question on that.
Yeah, go ahead and pull it up. And while you do, some folks that are listening will be familiar with Clawbot, or I think OpenClaw, which I think is the new name. I think they changed around multiple times. What is that?
Yeah, so Clawbot is a Linux-based integration into your computer that allows you to run an AI model or agent on your computer autonomously with permission and access to certain files that you give it that permission to access on the computer. This allows you to access some of the computing power on your computer, not have to worry about purely relying on it being able to pull data from the cloud, so it can run slightly faster. But also you can program in, a series of steps and such, so it can use the memory of your computer to continuously perform a process instead of relying on, cloud-based computing not timing out when it gets stuck on something. So really, the big advantage of Clawbot is it allows you to do much larger tasks, albeit Claude is better at doing some higher level stuff, but Clawbot is great at doing low level tasks such as data aggregation, data scraping for large persistent amounts of time.
I think just to pile on top, John, all of the data aggregation and then the ability to kind of put that into your scoring system, which I'm going to allow you to talk about. But the creation of this interactive heat map that you're going to show us was also generated through the use of AI. And I think that's another factor of this project that you've been working on that shouldn't be lost, because this is truly the data visualization tool that our internal team will get to use. You can zoom in and zoom out, and again, you can get as granular as you want to get with this interactive map. And I think it's a really powerful display of all the data that you've been able to collect. And so I think that just talking about the generation or the creation of this interactive heat map through the use of AI would also be interesting to the audience.
And to be clear, we did not really know how we were going to do this. We thought that some sort of heat map could be an end state of what we could use with the work that John had been working on, this scoring system, but we really had no idea of how we were going to implement it.
Right.
Yeah, John, keep walking us through.
So Claude has been a great asset to making this happen. Really, I'm not an expert on, developing stuff like this. I'm more of a, a number crunchers kind of guy. But Claude, I just, I told it, here's my data, here's what I want to do with it. Let's outline some ways to make this happen. And it was able to generate, frameworks that we were able to build off of to make this heat map possible. Specifically, it handled a lot of that, heavier coding to make, the HTML files, to iterate on it. A few times it got hung up and I had to, directly intervene to say, okay, we need to make these changes, or you need to change this about how it's running, specifically because we're integrating so much data into the HTML that, like, for instance, it had trouble loading. And we had to say, okay, how do we find a workaround to this? Let's ideate, let's brainstorm. And Claude has been great at, you tell it to do something. If that thing doesn't work, you tell it, okay, what are the workarounds to do this? It will list out the workarounds. You find the one that is best for your given situation and you tell it to implement that. I think it does struggle a little bit on the end of iterated self-improvement. For instance, if the heat map had an issue and I just told Claude to fix it using whatever it thought was best, it doesn't really always get there. So definitely some human input was still needed in that department, but otherwise it has done a phenomenal job at making the kind of the back end of this project possible.
Mm-hmm. Keep walking us through. We see the larger map and some of the zip codes that are outlined, but kind of take us through some of the features and then get down more to the granular level of getting into a zip code. Give us a tour.
First, I just want to real quick highlight the methodology. I mean, viewers can take time to pause and kind of scroll through this, but this just kind of breaks down how everything is working. I think that's kind of important to outline to make sure kind of, what I understand. This isn't a black box. This is, this is just pure data that is being reported in this heat map. It's not making any sort of, inferences or transformations. It's all based on data that we have collected and calculated and transformed ourselves into useful ways. I think really the best way to highlight the usefulness or highlight what this project can accomplish is St. Louis. St. Louis has been a great example of kind of what this can produce. So the basic idea is that every zip code has all the properties inside of all the multifamily properties scored and aggregated to form an overall zip code score. The zip code score is broken down by a few different classifications. For instance, income, vacancy, unemployment, travel time to work, percentage of population dependent, square footage size of the average unit, cost per square foot, the average space of the square unit, the year built, and the poverty in the area. We are looking to add some more indicators like crime, for instance, but this is still a work in progress, of course. Every zip code has been scored based on averages and standard deviations to produce this heat map where you can see, for instance, it is meant to break down the kind of investability based on macroeconomic indicators. So we can click on a zip code, let's say 63146. It would go ahead and populate the properties in the area, and it gives all of the properties a scoring of an A plus through an F, which of course is really more so just for a kind of an ease of understanding. But if we click on a property, it will zoom in on that property and give us kind of a quick breakdown on some of the metrics. For instance, how many units they have, average unit square foot, asking rent, asking per square foot, just a lot of different data that may be useful to anybody looking at this property. When we look at the full detail, we'll see it's attributed an overall score. Generally, in this current setup, any score 30 or and above is considered very good. But as you scroll down, you see it breaks down the scores into independent, macroeconomic individual scores. So we see, for instance, at this specific property, the monthly the rent is 38.1% of income. So it's a little higher than one would like to see compared to the median. In the mean, so that kind of knocks a score down. But for instance, the poverty in the area is really, really low, the amount of people in poverty. So that helps out the score. All those aggregated together give a total score for that specific property and allows you to look at all the different indicators and say, are these metrics strong compared to our underwriting model? Is this something that we could reasonably invest in and know that it's going to perform strongly?
What were some of the biggest roadblocks, challenges putting this together? I mean, was it the data, really putting the data together initially?
Yeah. So there was two main roadblocks that were kind of the most difficult ones. The first of which was figuring out, how do we even go about doing something like this? How do we create and construct the scores to actually make these metrics useful? You have, a million different numbers for a bunch of different zip codes. So how do we transform those metrics into something that we can score and rank against other zip codes and other properties? So just figuring out how to create that scoring system, how to weight it so it's, accurately representing reality was a real challenge. Took a lot of time of just, sitting there running through different hypotheticals and coming to, making some assumptions about, how would we want to score this compared to something else? Or, how do we want to weight the scores? Should a score on a certain macroeconomic indicator matter more than some other macroeconomic indicator? So it took a lot of, putting the data into statistical software, seeing, how relevant are these scores? How correlative are they to, different outcomes on the property side of things? But then the second big challenge was data aggregation. As I mentioned earlier, a large part of my time was just sunk into trying to pull data from CoStar, pull data from the Census Bureau, finding different economic indicators online. and it slowed down the process immensely. So we started this project back near the end of December, and really until the past couple of weeks, we just kind of hit a roadblock of, okay, I can get 10 more zip codes in or something like that, but that it's just not enough. It's not enough to, by law of large numbers, make this data useful. But the big transformation came with the integration of Claudebot and Claude to be able to just pull in thousands and thousands of metrics. I think currently we're sitting at somewhere around 5,500 properties, and that puts it at around roughly 40,000 individual data points we have now across the entire data set. So really, it's just been incredible at taking away that roadblock.
Because it really, I mean, what we went from basically having a bunch of data, not knowing what we were going to do with it. I mean, we had scores, each zip code had a score, but we went from that state to a full interactive map.
It was almost like the timing was perfect with some of the developments in progress in AI and this project, because we had essentially reached a point of, hey, the production's not high enough to continue down this path.
Yeah,
right? It was just too slow. John was, he's working his butt off, but we were only getting, 5 to 10 zip codes, maybe a week, maybe a little less. And so now we're able to scale it up, and now you get this heat map. For the data visualization. It's really incredible.
And I mean, how long did the heat map part? I mean, how long did the actual, the coding, the vibe coding, I guess, the work in Claude, to build the heat map? I mean, how long did that take? I mean, sure, you had to tweak it some and say, hey, don't display that like that, and do it differently. But how long did that process take?
In terms of functionality, in terms of like making it work how we wanted it to, and there still is some issues with it, especially when it comes to like geocoding the locations of the properties. But in terms of just like making it functional, seeing the heat map, being able to click on stuff, it took a matter of hours. I think over the course of a couple days, I got it up and running. I was up till 2 a.m. a couple nights, just pushing my way through it, trying to get something working. And really, just in the matter of a couple of days, we were able to get something really, really cool developed.
Yeah, it seemed like overnight. Go ahead, Blake.
Have any of you gone back and looked at any of the properties that we've acquired and compared it with the heat map? I haven't. Could we do that now for flats?
I can show you, for instance. Yeah, I can show you.
Solana. Solana's a good one, too.
Yeah, Solana is a good one. Let me...
Yeah, let's look at flats Solana and see what their scores are.
Yeah, let me share my screen real quick.
Well, and we've been using this. While you pulled up, John, I mean, we've been using it in real time. I mean, when we have acquisition targets, we've been telling John, and if it's in a zip code that we don't have yet, he's like, let me hop right on it. Let me do the zip code, and let's see what it shows.
Yeah.
So it's been like in a real time usage. That's why like St. Louis was built out, because we're going to do St. Louis, but then we were looking at a deal.
Yeah, so here's Solana, for instance. It's sitting at a score of a perfect 25. A little like it's not a perfect score, but that actually is to be expected. The reason that is that this heat map is ranking properties based on how good are the indicators if we were to buy it today. So Solana has been acquired for a while. It's effort and work has been put into decrease the vacancy, increase rents, different stuff like that. So that is going to put a pressure on some of the indicators, which would naturally tend to start decreasing the score. But again, like I said, the highest score you can get is a property where everything aligns. And the best example I can give is, let's say, like rent, for instance. A really high scoring rent property is a property that seems like the rents are a lot lower than they should be. And if you compare that with the other indicators, of course, a property, all else held equal, that has a rent that is a lot lower than kind of the median of the area that it's like being asked for. If that rent is a lot lower and everything else is held equal across the properties, then it indicates, okay, this rent could be raised quite a bit to fall in line with the rest of the geographic area. So that's just an example of how, a property that we've acquired for a while, we've kind of raised the rent into more in line of what it should be. Isn't going to have the highest perfect score, but a property that we have yet to acquire that we would be looking at buying may have a higher score.
So some of the properties that might be in the B, B minus, that are in a really good area might have the best upside for us and investors.
Yes, potentially. Yeah. I mean, ultimately, nuance still matters. At the end of the day, you can't capture every single detail. So really, this is more of a tool to give you insight and say, okay, this looks pretty good, but we've got to do further investigation. No tool is going to give you a perfect 100% yes, buy now. You know, if they did, people would be making millions on the stock market from it.
Yeah.
But yeah, it's a good tool to analyze what are the macroeconomic indicators. How can we compare that to our underwriting model to see like if this is a good deal?
I mean, for example, we were looking at a property in Louisville, and it was more urban and kind of downtown Louisville, and it was in what I would call more of like a transitionary neighborhood, and it's an example of really where nuance matters. Because the next couple blocks over really didn't look that attractive, but again, it's like this emerging area where people want to be, and there's a lot of activity that's going on, but issues with poverty was bringing it down, and crime, and there's just some challenges that brought that overall area score down. But to John's point, nuance is always going to matter, and so this is interesting also. So this is in Greenwood, our latest acquisition, which I would consider probably in a slightly better. Well, it's different. I mean, I think the quality of the submarkets, more suburban, is probably a little bit better than where Solana is. But Solana is, oh yeah, well that made that, and honestly, for thinking about Flagstone, that was one of the first reasons why we didn't like it, is because it's a little bit further away from an interstate. So actually, that does track.
Yeah. The travel time kind of is the main penalizer. Also, the rent is slightly higher than income. But what also needs to be understood is that these scores are kind of holding income constant. So, for instance, the income is flat standard across the entire zip code. From the Census Bureau data, you get one median income per year across the entire zip code. So you can't really get property level data. So then the best we can do is applying that same income to all properties. But what it leaves out is that, some properties tend to attract, higher income individuals.
Well, and across this zip code in particular, the western side of it is in a much better school district than on the eastern side of it.
So generally, that's kind of where the nuance comes in, is like generally in a case like that, where like, okay, this is in a better area. People who live here tend to be higher income. It's like, okay, well, maybe we can, put less weight on that specific, score.
Yeah.
We had a conversation really to start the week out this week about AI, and garbage in gets you garbage out. And I think I've experienced that. You give it a prompt and it doesn't exactly deliver to you what you're essentially asking for. And it's easy to get frustrated and be like, well, this doesn't work. But at the end of the day, it's all about the input. And if you want a quality output, you have to ensure that your prompt and the data that you're inputting is of the highest quality. And so I think across really the few examples that we've discussed, Blake with the monthly and quarterly reporting, making sure all the property data, it comes across in a quality fashion. And then John and all the data that you're crawling and scraping from the internet and then aggregating. Can you guys, maybe Blake first and then John, just talk about ensuring and doing the work up front to ensure that what you're inputting into Claude, into ChatGPT, into AI is of the highest quality, so that your life is made a little bit easier and the product is improved? Because I think we've all gone through that prompt of like, oh, this prompt stinks, the output stinks. Talk about writing the prompt and making sure that the data that you're grabbing and inputting is good stuff.
Yeah, this is a great point. And Spencer said in our meeting earlier this week to make sure the outputs of it still have like a Gray Capital soul to it. I think that was a good way to say it. And I think this is also what's going to differentiate all sponsors and GPs, because anyone can kind of prompt an AI and prompt it differently and iterate on that prompt. But what you do with the output that it gives you is still going to be a differentiator. And it's in some ways, it's almost like more frustrating. Like on the reports, it does 80% of it for you. So now my expectation is, oh, you already did 80% of it. Like, I don't want to like do the last 20. But before, when the expectation is I have to do it all myself, it's fine. I'm doing it all myself. But now when somebody else does, or something else does 80% of it, and you're like, oh, I still have to mess with it a little bit.
You have to write one. It's like we have to write one paragraph still. And you're like, really? I have to do it. I have to write still.
Quick. The expectation is like, no, you just finish it. Just like get it all the way there. But I think that's going to be super important, and is going to, still going to be input from us and from humans, and it's going to make the the difference, I think, from sponsors and
Yeah.
deliverables and things like that.
In the realm of reporting, whether it's monthly or quarterly, we can upload variance reports. We can, provide the comments from our property management arm. We can pair it up with the data. Claude can be able to jump in there and kind of recognize, hey, these are the CapEx projects that are going on the site. This is where the expenses are made. But it can't really tell the story of what's happening at the resident event. Why maybe we put in, why we resealed and striped the pavement, or why we provided this CapEx project new outdoor amenity. So it's jumping in again, keeping the same tone, the same, personality and soul that we have in our past reports, but making sure that at the tail end of AI generated data that we're incorporating that in the qualitative kind of analysis of the monthly or quarterly performance.
Yeah. And that was really well said.
Yeah.
Yeah.
John, what about on your end? I'm just curious, and maybe just kind of a quick answer. You've got so many data points that you just shout out a number, and it was a large number. How are you ensuring that the data going in is of high quality, rather than maybe that garbage, so that this interactive map really is kind of accountable and accurate?
Yeah, the main way was first when I, imported the what has been done so far. I made sure it understood why the data is the way it is. So, it understood, here's why we made this transformation. Here's why we're using this data point. Here's why we're doing what we're doing, so that it doesn't start, hallucinating and saying, well, actually, I'm going to use something else, because that has been an issue in the past. So once it understood, why the data was the way it was, then it became a process of like reinforcement training to say, okay, now I'm going to need you to pull it from CoStar, and but specifically, I need you to be able to do the same process repeatedly on the same zip code before we get you to go into other zip codes. If it did a zip code and it did it wrong, and you can't open an Excel file while it's working on it, it can't append the Excel file while you have it open, so you have to leave it closed. You have to make sure it can do a zip code correctly first, but then you have to make sure it can do multiple zip codes in a row, like 2 zip codes in a row, for instance, correctly, before you can let it kind of run on its own. So what I kind of mean to say is you have to kind of hold its hand a little bit through that kind of initial learning process. I was spending hours upon hours the previous week just kind of holding its hand to make sure it could do it repeatedly and efficiently without making errors. And even still, I'll still kind of, monitor it while it's running. I'll be working on something else, but, glancing over to the side, make sure it's not, flubbing something up, and having it take intermittent breaks so I can just check on it to make sure it's not messing up anything. So what I mean to say is that it's autonomous to about the 99%. There's still kind of that 1% that will, always kind of remain around of, once you kind of leave it on its own, you got to check in every once in a while. Just like, for instance, if you have an employee under you, you still got to check in to make sure that the work's being done the way you want it to be done.
Mm-hmm. So we're babysitting the machines, or I don't know, they're telling us what to do.
I think that's the power of it. It's over there working hard while you're also being able to divert or give your attention to something else, while you're also able to check in, and it's just plugging away.
Yeah. I wanted to share 2 things that I've been working on. It's a little bit of show and tell, but something.
John, have you seen these?
Yeah, I think John.
Okay. Yeah,
well, John's seen the operator terminal. I don't think he's seen the grand screen. So this is the first one. This was again much of this. Sorry, I've got way too many tabs open. This was just an attempt to build an interactive, I guess, like data center to bring in macroeconomic data to be able to synthesize it, but also to analyze deals, everything from PDFs. And its end state, which I'm working on right now, is as an Excel plugin. I have it working as an Excel plugin, but what I have to finish is allowing the Excel to go back and forth between this program and Excel. And so we can essentially manipulate Excel through this terminal, and be able to export data from the terminal over to the Excel sheet as well. So essentially what I've done here is built an interface that I'm calling the operator terminal, for lack of a better term for it. And the inspiration was kind of like an old school, like actual like CRT terminal, that you might have seen like on Wall Street in like the 70s and 80s. And I just wanted this to be a full up heads up interactive dashboard for macroeconomic conditions related to multifamily, and then also be able to act as a deal screener. So what I have connected here are many different APIs, everything from census to BLS, to different rent trackers, to news feeds, to market tickers. And then I have also been building in a lot of, I guess, logic and calculators to run different types of analysis. So everything from a full Excel model. I took our model in Excel, I converted it to JavaScript, and then I'm hosting it through this terminal. I also have like a more basic calculator. I also have a calculator that can do Monte Carlo simulations, where essentially can run like 3,000 different scenarios and to give a probability distribution. So again, when I come into the terminal, it's giving us a heads up of where where rates are, giving us some news, and so it's talking about Congress' new plan to address housing affordability. It's giving us an update on where the 10-year Treasury is, and then all of this it's also trained on Gray Capital, our acquisition criteria, our philosophy, everything about what we've done, what we try to do, what we're looking for. And I took a lot of time this was just, again, kind of a weekend project, but I took a lot of time to give the operator a lot of personality. And so he has a full backstory, personality, he asks questions in a certain way. And so like we can do anything from, as an example, I have a bunch of like commands here. So like I can do like a meta-analysis. And so when I do the meta-analysis, it starts pulling in, you can see here on the right side, it is starting to run through its Monte Carlo probability analysis. This is a valuation indicator, rent, and this is all national numbers, rent growth, distribution forecast going 12-month forward, as well as cap rate, probability interest, rent growth, cap rate distributions. And again, this is trained on dozens of CoStar reports, active CoStar reports, but then also a significant amount of live feeds itself. Then I can export this into a brief, do a handful of things. And so this is pre-programmed to give an educated forecast. And obviously, geopolitical risk is at the top of the headlines with the war in Iran, keeping volatility elevated. The 10-year it's going into the range of the 10-year, flight to quality. And what is anticipated to have in the next 30, 60, 90 days. Again, I haven't read any of this, of what it said, but it's saying, again, it's giving info on the Fed funds rate. It's saying the Fed's going to hold. Iran conflict's going to de-escalate over the next 60 days. It's giving a range of probabilities for the 10-year, for cap rates. And in 90 days, it's saying, looks like we're going to stress test the valuation range, and suggesting a 35% spread in potential asset values by year end. So some of this still has to be tweaked and modified and adjusted. I can pull up the latest census data. But I was able to build this, and what has been amazing to me is I've never done really any programming or coding. And been working on this for like probably a week and a half or so. Just been doing it like on the weekend and in the evenings. And I built an entire, because this user interface that is a plugin for Excel, and it also will pull, but I have a full back end as well. And so I have all these databases that are being hosted, remotely. And honestly, I understand probably 60% of what I've done. And I have a bunch of README files that are explaining it, that I had to write for myself so I can go back and understand what I did. But it's really kind of inspired me, and I think it's inspired us to say, what else can we build for, the firm at Gray Capital, our investors, our residents, our employees, and seeing the opportunity to build some really kind of bespoke tools that can do a better job. I think the risk is, not spending too much time building the tools, but for some of the opportunity of really kind of working on the business and building out, organization exactly the way that I and we want to build it, and not being beholden to third-party operators. And all of this goes to show, and it's very relevant to the conversation in the economy that's been taking place over the last several weeks of software and software companies. And again, if we can do this, or someone who has almost no programming experience can go and do this, what else can we do? And it brings to question some of the values of some of these software companies. The next tool that I want to share with everybody is a pricing tool that I've built. Now, this is a prototype. It's not finished by any means. Now, this is built upon about 6 different APIs and market intelligence from CoStar and RealPage. This is just for the Indianapolis area because, again, there's a lot of data and we obviously can't do the whole country. I wanted to focus to see can I build essentially a rent calculator to figure out where rents should be and, kind of like a bare bones kind of revenue management system. Now, what's missing here is all of the information knowledge about like our property. So like a typical property manager, you would know what all of your availability is, your leasing history, your current rents. That all is not connected yet. Over time, it will be. And so the way that this one works right now, we'll use Solana as another example. Drop in the property address. It also has an AI interface, so I can ask it any questions I want, which need a little bit of work on there, but it works pretty well. It's multifamily. You don't have to input how many units it is. 39 occupancy. Let's say we're 91%. And then I can set a pricing goal between balanced, maximizing rent or maximizing occupancy. Keep it on balanced, select new lease or renewal. This will be built out more related to your actual release expiration schedule at its end state. But a lot of this is just to see, okay, what can we do? What can we build? How far can we take it? Actually, let me do it this way. Let me see. I think if I search Solana, I'm risking this just not working. That's all right. But it should find Solana, and it should pull in all of its unit amenities by doing a search of what it has. We'll see. Oh, there it goes. So it was able to pull in, found Solana at the Crossing, 389 units. It has the year of construction. Now, like if we have an Aura score, I forget what our Aura score, which is like a reputation score. Let's call it 75. And then let's analyze a price. Very quickly, it pops up a satellite view, and it starts giving information. So this is for a 1-bedroom, I believe. 1 bedroom, 1 bath. Let me make sure. Sorry, 2-bedroom one. It's a 2-1. 2-1. So it has high degree of confidence. Both sources agree between 3.6%. There's 17 comps available because it has all these market reports. It identifies concessions in a given area. So it's a concession strategy. It's saying market concessions range about 12.5%, $160 a month equivalent. And so it's suggesting if you're going to do a concession, do a one-time move-in bonus over rent reductions. That's kind of just like standard sage advice. One of the big indicators is I wanted to incorporate like a market competitive score and how like hot or cold the market is. And so like it's a relatively cold market to cool market because there's a lot of new supply coming online. I wanted this to be, more predictive in being able to see around corners and not like why are rents priced they are today the way they are based upon previous data. I want to see where rents are going so we can either be more aggressive when we need to be or more defensive when that's appropriate. And so it breaks down essentially all of your amenities, giving a certain price for those amenities, the competitive score, the class score, a reputation modifier from the Aura score. It also allows you to do scenario modeling. And so again, this is all relatively linear math. And that's where we're working with John on actually like fine tuning the math. But again, I built this, and this is again just an example of leverage. I spent Saturday afternoon driving around up at my farm with the dogs planning this out. And I spent Sunday afternoon driving around literally with my laptop in my truck building this. Yeah. And I finish it in the evening. So you can model in again, like what rent change, if you move rents around, what potential time to lease up would be, as well as your estimated occupancy. So just a little bit of forecasting. Again, the math on that isn't as accurate as it should be. Then I have all like your traditional actual like kind of comp information, price per square foot, rent per square foot, rent versus distance. Like here, I need to work on the scaling. Rent versus distance, again, need to work on the scaling here. Lease term curve, which can be set down here. And this gives, this is the comps. We can basically show like a leasing term matrix based upon, 1 month to 14-month rents, premiums, and discounts. And the idea is, this being a tool for property managers and asset managers to determine how we should price these units. Sorry, go ahead. I think you were going to say something, Griffin.
How and why, right? Like this AI kind of rent forecaster, market rent setter. We have access to that. We can pay for it. But in those models and that software service, it doesn't necessarily give you the causation of why your rent recommendation is what it is. So I think your tool is offering something that we don't currently have access to for our property staff or for our property management staff. Basically, it just says, hey, $1,200 a month. That's what you should be, asking for in rent. That should be your effective rent. But that's really all that they can see. There's no really like, here's why and here's how to adjust. Which I think is cool. It's a very cool.
There's other products that do this on the market. I think the complaint is exactly what you said. It's a relatively black box.
Right.
It's giving you a recommendation and you're not really sure why. And as we use these products, there's a lack of trust. And you're just like, I don't know why. I just don't trust it. It's telling me to do this, but I don't really trust it. I don't think that's right. And so what we wanted to embed in this is just transparency to say, one, how confident are we on this suggestion? It's like, hey, there's a big range of where the comps are. So it's like, this is what the number we're indicating, but we're not confident in that number. Use your own judgment. Or no, we're really confident. You can be sure that you can go put this in front of prospects and, it should help you achieve whatever your goals may be. But I think transparency is key. And the other why, the why is, this thing is the largest pain point and potential, opportunity or loss in the business. I mean, there's a lot of drivers, but, every dollar in rent directly relates to value up and down. And so missing being under market by $50, you're leaving thousands of dollars, hundreds of thousands of dollars on the table, and potentially millions in valuation. If your rent is too high, you're going to have problems with occupancy. You're going to be at kind of mid 80s occupancy, and you're going to be scratching your head. And it could be other things. It could be you're not marketing. It could be a variety of factors. But it would be helpful to have an indicator of are there market conditions. I think the market currently, which is relatively suppressed, it's a cooler market. Indianapolis has delivered a lot of supply, as have a lot of markets. And I think a lot of operators are scratching their heads and they're like, I'm at 89%. Why? And, it's obvious there's all this supply that's come online. There's all this sentiment. But I don't know if that's necessarily pumped into some of these scores.
Sure.
And so to try to give the market intelligence of trying to forecast the trajectory of growth as being a component, I think is unique. But then just being transparent of like how we're coming up with this number. Again, I say all of this, and this is not the end state of what this tool is going to be. This is really a early prototype. To see what we can build with the tools that we have, the data that we have, and eventually to build something better. Why Great Capital, besides like the opportunity to set our rents appropriately, we're spending over $100,000 right now at Great Capital, closer to $200,000 on software that does this.
And you did this in 2 days.
Yeah.
I want to be respectful of Blake and John's time, and I certainly don't want to end the conversation, but we've held them captive here on the Gray Report podcast for a little bit too long. So if you guys need to jump, please feel welcome. I don't want to hold you hostage.
Yeah, well, John, Blake, thanks for being here. We're all working on some really exciting things. You guys are doing some really exciting stuff, and we'll have both you guys on here shortly. Blake, see what's going on in the market on the capital market side of things, Great Capital, and then John, obviously working on several projects that we're going to want to bring the Great Capital audience fully read into here in the near future. So thanks, guys.
Thanks for having us.
Yeah, thanks for having me on.
Griffin, that was an incredible conversation. Blake and John, I mean, what they're doing is incredible. What you're doing the same stuff, right alongside both those guys. I mean, you're basically leading the project with John and obviously working with Blake. I don't know. Any last thoughts before we call it a day?
I think just operating kind of individually and alongside Blake, it's encouraging to see the progress that Blake and John have been making, the progress you've been making. Looking forward to next Friday to try and kind of group together and a group think and get on the exact same track. There's so much potential that can be realized here in the next couple of weeks in regards to how we're using AI. And so the only thing that I want to say is that thank you for providing the tools to our team. I think that we are going to be currently steps ahead of other folks in the same industry. But if we continue down this path, we're going to be, leaps and bounds, and we're going to have a first mover advantage, and it will be observable and noticeable here internally. But the hope is that if you're a partner of Great Capital, an investor in Great Capital, or you're a service provider at Great Capital, you can see the efficiency coming through on your end. And so it's not just going to impact internally, but also outward. And I'm excited to kind of be able to see that and realize that and hear about it from our investors.
Yeah, no, likewise. I appreciate that. And yeah, no, at the end of the day, we don't need to get out of the sandbox. Mm-hmm. And that's what's exciting is we're getting out of the sandbox and we're seeing kind of the real impacts and accelerating of that real impact. So yeah, I'm excited for the next, 3 months, 6 months, year.
We got to get that LP interactive deal room fired up.
The first deal, it'll be fired up. It'll be ready to go. And part of the conversation is, orders of operation. It's on the roadmap, as they say.
Awesome.
All right. See you guys next week. Make sure you like and subscribe. If you're not subscribed to the Great Capital YouTube channel, my gosh, you're missing out. Okay. See you next week.